Steve here, and welcome to today's Explainer. The closing bell for April has officially rung, and man, if you've been watching the tape, you already know. We just survived a session where the record books literally got rewritten right while the energy pits basically caught on fire. Today, we're stripping away the market noise. No fluff, just the raw hard numbers and the massive macro forces driving them. Let's dive right into the April ledger.
Listen to the chatter right off the trading floor today. Quote, "We are closing April on a knife's edge. The technicals are holding, but volatility is screaming." That isn't just some suit trying to sound dramatic. That is the exact, palpable tension we are feeling in the market right now. We are balancing historic, all-time highs against some of the most unpredictable geopolitical crosswinds we've seen all year.
All right, let's stop talking around it and get straight into the tape. Check your charts. What we're looking at right here is the raw action of the Thursday closing bell. This is where the rubber meets the road.
Look at this massive split on your morning ledger. You've got the S&P 500 settling at an absolute record, 7,178.50, up just over 0.5%. But right underneath it, Brent crude took a violent nosedive, shedding 3.5% down to $113.89. Meanwhile, gold is just digging its heels in, holding its ground at 4,710 as that classic safe haven. And Bitcoin, well, Bitcoin's feeling the squeeze, drifting down just a bit to test support at 75,737. These numbers brilliantly illustrate a market that is completely torn in half between equity euphoria and commodity panic.
Let's break down that S&P action first. The index put in a truly historic performance today, settling right at 7,178.50. Yeah, it cooled off a tiny bit from those intraday peaks, but make no mistake, the underlying bid is incredibly strong. But what you really need to draw a thick line through on your own screens is that looming 7,200 level sitting just above us. That is the critical psychological barrier we are marching toward going into May.
Now contrast that smooth equity rally with the absolute bloodbath in the oil pit. Look at this collapse in Brent. This right here is the story of the day. Brent tagged a massive $126 intraday high this morning on pure strike fears, and then, boom, absolutely cratered back down to 113.89. Why? Because the June contract heads for expiration tonight and traders were dumping risk as fast as humanly possible. It was a violent, sharp reversal that completely vaporized a lot of late longs.
But you know the drill, right? The tape only tells you what just happened. To figure out what happens next, we have to look under the hood. We're pivoting now to the fundamental data. This is the macro engine that's going to drive the very next leg of this market.
And here is the first major piece of that engine. 2.0%. That's your Q1 GDP rebound figure that just hit the wires. Now on paper, it looks solid. It's a clear, undeniable acceleration from the dismal 0.5% we saw at the tail end of 2025. But listen to me carefully. Do not get comfortable with this number.
Because when you strip away the paint, the reality of this GDP illusion isn't pretty at all. That 2% headline number, it is low-quality growth. It's being artificially propped up by government back pay from the shutdown alongside a mountain of defense spending tied directly to the Iran conflict. When you actually look at the underlying reality, the true consumer demand signal is incredibly soft. Make no mistake, the private sector isn't driving this bus, the government is.
And that soft consumer demand is running headfirst into a brick wall with this next number, 3.6%. Today's GDP report also revealed a serious jump in the PCE price index to 3.6. Guys, this is absolutely crucial. It lays out exactly why the Federal Reserve is officially backed into a dark corner right now. With inflation running this hot, the Fed has zero wiggle room ahead of tomorrow's massive 8:30 a.m. data drop.
And while we're sweating the Fed, we also have corporate landmines to navigate. Enter the Apple audit. Apple reports in the after hours. The whisper number on the street is $1.92 in earnings per share on $109.4 billion in revenue. But investors aren't just looking at the top line today. The real question is how much those 3-nanometer chip supply constraints and ballooning memory costs are going to chew up their margins. If Tim Cook and John Ternus can't show a clear path through this supply chain fog, the tech-heavy S&P is going to feel the dead weight of it.
All right, let's shift our focus to the geopolitical ledger, because honestly, you cannot trade a single lot in this market without a firm grip on what's happening in the Middle East. The standoff in the Strait of Hormuz is no longer just a passing news item on the ticker. It is a permanent market fixture. The U.S. naval blockade is aggressively tightening the screws on Tehran, and the political rhetoric is hitting an absolute fever pitch.
To understand exactly what the market is pricing in right now, just listen to this quote. Defense Minister Israel Katz warned this morning that they may have to, quote, act again to ensure Iran doesn't remain a threat, end quote. That statement right there is exactly why the market is holding on to so much tension. Traders have fully priced in the terrifying, very real possibility of a weekend strike.
And that brings us to the power plant ultimatum. Let me define the exact stakes here for you. We are talking about the looming threat to literally decapitate the Iranian domestic power grid. The threat of this ultimatum is the only reason oil didn't stick at that $126 spike we saw earlier today. Let me tell you, if those lights go out over the weekend, $113 Brent is going to be a distant, distant memory come Monday morning.
So how the hell do we trade this? Let's map out the battlefield for May. Right now, the S&P is trading roughly 5% above its 50-day exponential moving average. In any other year, I'd look at that chart and scream that we are dangerously overextended. But with this massive geopolitical premium baked into the cake, it just constitutes the new normal.
We're staring down a classic bull versus bear street fight. The bearish reality is glaring. You've got low-quality, government-led GDP growth and a hot PCE number that essentially takes a shotgun to the whole soft landing narrative. But you have to respect the bullish catalyst on the other side of the trade, massive Apple buybacks and the potential for a sudden Gulf peace dividend. If tensions just cool off a bit, we could see a squeeze on the shorts that rockets us straight to 7,500 by Memorial Day. So with all these massive competing forces slamming into each other, what is our play? As we flip the calendar to May, there is literally only one strategy you need to focus on: capital preservation. It is the only trade that matters right now. I am putting down a strict, disciplined survival guide for navigating the incredibly volatile tape we have ahead.
Grab a pen. Consider these your final marching orders. First, respect the 6,800 support. Your 50-day EMA at 67.95 is your absolute primary line of defense. If we lose that level, watch the 200-day SMA at 67.12 because that is the very next stop on the elevator down. Second, the Brent roll. June Brent is completely gone. You absolutely must be synced up with the July contract before tomorrow's open. And finally, the Apple buffer. Do not try to be a hero and chase the after-hours volatility. Let the conference call end. Let the numbers settle. Market discipline pays.
The ledger doesn't wait for latecomers, folks. As we walk into a weekend absolutely loaded with massive gap risk, I leave you with one final, critical question. Will your capital survive the weekend? Stay strictly disciplined, watch those moving averages, and keep your risk incredibly tight. This is Steve. The April ledger is officially closed.